Hello, and thank you for downloading another episode of Your Life Simplified. My name is Brian Leitner, and I'll be the host of this podcast. In this episode of Your Life Simplified, we're going to talk about sequence of return risks, which is a different type of risk that is in your portfolio, and one that may not be addressed enough and that most people may not think about, but it can be a critical piece of your overall financial planning puzzle and really impact your overall financial plan, especially when you make distributions, so as you move into retirement. And today, our guest is Justin Richter, who's a senior wealth advisor at Mariner Wealth Advisors in our Kansas City office. So Justin, thanks for being here.
Brian, thank you for having me. Looking forward to it.
So Justin, maybe just a little bit of background on yourself. If you could tell the audience, who you are, what you do, what that looks like.
Absolutely. Been with the organization for 6 years. Overall, have experience within the investment and wealth management business for over 15 years. In addition to managing clients' financial assets and their financial well-being, a key member of Mariner's investment committee.
Thanks, Justin. Again, thanks for being here. As we talk about this sequence of returns risk, how would you begin to go ahead and identify what that is for the audience?
Absolutely. When we talk about sequence of return risk, it's something that sounds foreign to many people, but really the gist of it is the timing at which returns occur within your portfolio can have a dramatic impact on the future results of the portfolio. We may talk about having returns of 6% per year when we're doing financial projections, but we know that reality is not that. There's going to be significant volatility that occurs from year to year. It really does not matter while you're accumulating capital, but when you start to take distributions or being reliant on the portfolio capital, that timing of when returns occur, especially negative returns, can have, again, a dramatic impact on portfolio performance.
Yeah, Justin, just before the show, we took a look at a couple of different examples that we ran. And just to give the audience an idea, we took a portfolio. It doesn't really matter what the dollar number is. Maybe it's $1 million in client one versus $1 million in client two. And in the first example, that individual had their first few years were positive. And it ended up, 25 years later, that they had a great deal more than the $2 million and everything was great. But in client two's portfolio, they experienced negative returns in the first 3 years, and they ended up running out of money before that same time period. To your point, the sequence of the returns and when you have those returns can have a dramatic impact on your overall portfolio.
Timing is everything.
Timing is everything. And so you just mentioned a second ago, from an accumulation perspective, when we think about as people are saving money, they're still working, the sequence of returns may not obviously have a huge impact because you're not living off of those funds. Mm-hmm. But the distribution phase is where they have the biggest impact. When is the dramatic impact of sequence of returns, from what you've seen?
Mm-hmm. The day of retirement. As soon as something can happen in the early years when you're starting to withdraw from capital, that's when you're going to see the most significant impact. When you're in the accumulation phase, that downside volatility is actually a benefit for you. At that point, you can actually add capital to the portfolio. But on the opposite side, when you're in retirement, you're reliant on those funds, the opposite happens. Dollars taken out don't have the ability to recover when the market usually recovers, whether that's 6, 12, 24 months down the road.
And thinking about that psychologically, you've saved your entire career. You're about ready to live the good life. The day you retire, boom, a 20% correction, whatever that looks like. That's dramatic not only financially, but just psychologically, because I just took myself, out of the workforce, right? You work with a lot of clients. How do you mitigate that? How do you navigate that with folks?
Yeah, I think the number one issue is for as an advisor, be aware of it and educate the client as early as possible on what sequence of return risk is and how to avoid it. So when we bring on a new client to the firm, there's a lot of information that we go through, and it's important to go through the details. First and foremost, of course, we're going to walk through with that client their goals and objectives and really prioritize those goals and objectives as we look out over the short term, medium term, and long term. As we're going through the details, it really is important to have the inputs for that plan as detailed as possible, and especially the cash flow analysis. So as an example, as we're going through that, the most important part of that cash flow analysis is really getting a good handle on what spending is currently and what it's likely going to look like in the future. When we go through that process with our clients, we try to break down those expenses into tiers, where ultimately we are going through the process of separating what are core or fixed expenses. Those would be whether it's a mortgage payment or rent. That could be utilities, car payments, things that you just absolutely have to pay. Separating that from discretionary expenses, whether that's eating out, travel, other things that you can live without for a period of time. You may not be happy about it, but if it's in a dire situation or an uncomfortable situation, those are things that can be adjusted. And then the third category that not a lot of people think about when they're breaking off expenses and cash flows is gifting, whether that be charitable gifts or gifting to kids and grandkids. And that can also include, say, 529 plans for those kids or grandkids. So getting an idea of really what those expenses are and starting to categorize in your mind the importance of those given expenses.
So I appreciate the way you categorize those and broke those out. What I think other listeners greatly appreciate is the fact that you didn't use the word budget, because nobody likes to hear the word budget, right?
Yes. So beyond the cash flow components, the other piece that we take very seriously is looking at the assumptions that are going into the plan. So the plan is only as good as the assumption and data that goes into it. One that I think people tend to not spend enough time on is thinking about the expected return data. Most planning softwares will use some form of linear expectation of returns. And what I mean by that is that if the given return assumption is going to be whether it's 6% per year, 5% per year, 7% per year, whatever that number is, it's expected in the plan to occur each and every year. We know that that's not reality.
Because otherwise it would always look good, right?
Yeah, absolutely. So we know that's not reality. So it's important as we're looking at the portfolio and trying to do projections for the retirement planning to really stress test the actual returns that the investor might experience going forward. So again, rather than expecting 6% per year, we look at the portfolio composition, what has been the historical volatility of that portfolio, and then run the Monte Carlo analysis to run thousands of iterations of that potential volatility pattern to see what ultimately happened in that plan. Really, what is the ultimate probability of success that all those objectives and goals that we talked about earlier, that they actually get met.
With random rates of return and standard deviation and interest rates. So the idea is to depict a more realistic scenario as opposed to linear?
Absolutely.
Okay.
So that helps us to really get into more detail of what could happen rather than maybe showing a rosy scenario of that constant return pattern. From that, it can show us if there are potentially shortfalls. So if that probability of success is not as high as we'd like to see it, we can start to have the conversation early on how do we fix it, how do we avoid it. Really, the primary area comes back to the cash flow conversation where we are looking again at those discretionary expenses. If we get into a challenging environment right when retirement happens, or whether it's 5 years into retirement, how can we start to make adjustments and cut back on some of those non-necessary items?
What I love about that approach is, you're testing it. You really are testing it, right? You really are stress testing. You're looking at it from a couple different scenarios. From a linear perspective, you could be great. And I think there are a lot of folks out there that just say, look at the 6%, 7% a year rate of return because that's the good ballpark. If I'm going to make a decision, I'm sure if listeners are going to make a decision that, hey, this is the day I'm going to retire, I want to make sure that I truly understand what's going to take place and what the risks are before I go ahead and do this. So if you can see somebody that's failing, to your point, you can go in and look at the cash flows, look at the expenses and say, hey, we got to make some changes. So I think that gives everybody peace of mind.
Right, absolutely. So the expenses is one side of that, things that can be delayed, whether it's large purchases, new cars, looking at gifting. On the other side is income. That's the other thing that hopefully is within the control of the individual. If someone is still currently working and you know that there's the potential for a gap, it could provide some motivation to add an extra year or two of full-time work to build up a larger asset base so that the sequence of return doesn't matter as much in that planning process. Also having contingency plans for maybe transitioning to part-time work. If the ultimate goal was to retire at 65, perhaps we can put in scenarios where there's part-time, whether it's 20, 30 hours a week that would occur for another 2-3 years after that period to provide additional cushion within that plan.
Those are all great points. I really like and appreciate what you said too about the fact that you may have an expense, but you could always push that back, right? And so if you were going to remodel the kitchen or take that vacation, taking it in year 1 versus year 5, if the portfolio is growing, the plan may allow for that expense to be had in year 5 versus year 1. It doesn't mean that they can't do it, but just walking them through the various scenarios, I think it's great.
Yeah. So in addition to looking at that cash flow approach, another approach that we'll tend to look at from time to time that many listeners may have heard of is the 4% rule. For those that aren't aware of what that is, the 4% rule is looking at spending 4% of your asset value each and every year. So that way, if the market's up, you're getting a raise of what you can take out of the portfolio and spend. If the market is down, you need to forcefully cut back if you're only taking that 4% from the portfolio.
So most basic example, if somebody has $1 million, they can take out, say, $40,000 in that example. And that's in addition to whatever they might receive in terms of outside income, like Social Security or pension or something of that sense, correct?
Correct. So that's one plan, although there are some challenges to that. Can a person be disciplined enough to actually reduce spending when that 4% becomes a lower number than what it has been in past years? The other challenge,
just due to market loss or something of that nature?
Due to market loss. The other challenge may be historically, if you've had a stronger return, say 6 to 7% from a balanced portfolio, we've obviously had a good run in the markets over the last 10 years. So we're to a maybe more challenged environment as we look forward over the next 10 to 20 years. So maybe that 6 to 7% return is only 5 to 6 or maybe lower. So if you're looking at trying to maintain the purchasing power of the portfolio, if you're taking out 4% and we have 2% inflation and you have other tax and other costs, you're moving backwards in a hurry in that scenario. So in that situation, the 4% rule may be becoming more like a 3% rule if you were to look forward over the course of the next 10 to 20 years.
And this 4% rule is for our listeners who don't know, it's well documented, it's widely used in the business. Nothing's perfect, to your point just a second ago. My question might be for you is, if I'm retiring at, say, 65 or 70, whatever that age is, at 4%, and I know I have X amount of years to go, as I age, so maybe I'm now 80 years old, does 4% still make sense? Or if the market's grown, can I take out more? What does that look like?
So it really comes back to the goals and objectives of, if your objective is to try to leave as much to heirs or charity as possible, maybe you leave it at that 4%. But if there's not a significant goal to leave a great amount of capital to other parties, then absolutely it makes sense as your life horizon shortens that you can take a larger percentage of the portfolio and not necessarily have to worry as much about outliving your capital.
Make the last years your best.
Exactly.
Okay.
Hey, this is Scott Sturgeon. I work on the team that makes your life simplified a reality. We'd love to have more information on our listeners so we can ensure that we are tailoring content to what you're interested in. For the next several episodes, we are going to give away a pair of Apple AirPods. Being considered for the giveaway is easy. Simply email your age, state you live in, and 3 topics you'd like us to address in the future to podcast@marinerwealthadvisors.com. We will pick a winner at random during the next several episodes from those who email us. Again, email your age, state you live in, and 3 future topics to podcast@marinerwealthadvisors.com. And now, back to the show.
What are the other ways that when you talk to clients about, how to mitigate this? Because, again, when everybody's putting money away and, it's long term, I don't need to worry about it. Well, now I'm about to retire. I've just retired, and I see the volatility that's taking place even right now. I mean, what are maybe another strategy that you might leverage with folks?
Yeah, another strategy that is relatively common is to look at what would be called a bucket approach. In a bucket approach, you break your portfolios or accounts into, as it sounds, different buckets for different purposes. Those purposes, we're looking at short-term potential spending needs, intermediate needs, and then long-term growth potential. So when we walk through that type of situation, your short-term bucket will be comprised mostly of cash and equivalents. In most cases, depending on the individual, that underlying cash equivalents will be equivalent to whether it's 6 months of living expenses, 12 months of living expenses, sometimes more, depending on the comfort level of that individual, of how much they want to have readily available and not have to be forced to sell assets at an inopportune time if indeed the market does correct.
And when you say cash equivalents, CDs, money markets, things of that nature?
Correct. Things that are liquid with very limited volatility.
Okay.
So that would be a potential for short term. Some clients, though, especially in a low yield environment like we have been for the last 10 years and likely will continue to be for a long period of time, don't want to have too large of a cash balance that's earning close to nothing. In those cases, we've done for clients or advised to be able to utilize their taxable portfolios with either a margin or a securities line of credit. So that securities line of credit or margin would basically allow them to borrow from their portfolio if they did have a significant need that occurred at a time where it was inopportune to have to sell portfolio securities. So that way they can stay more fully invested, so they don't have that what we'd call cash drag, reducing the overall portfolio rate of return. And then that way, if they're comfortable with it, they can utilize that line. And then whether it's 6, 12, 24 months later, when the market environment has recovered, at that point in time, they can sell the underlying securities in the portfolio that would be needed to pay off that line of credit.
Sure. That makes a lot of sense to have that type of optionality.
Yeah, so definitely provides options, although some people are just against having any sort of debt or debt-like instrument. Yep. So it's not for everybody, but it's another potential tool in the toolbox, so to speak, to handle that bucket approach for short term. The next would be looking at medium term. And for that, we want to have rolling capital available that's providing liquidity that's, again, not going to force us to sell assets. So one area that tends to fill that bucket is a diversified bond ladder. So having maturities that are happening either on a monthly basis or a quarterly basis that over the course of the year will provide enough income or distributions that will be covering the spending needs for that year. That way you're getting bonds that over a period of time are gradually providing cash flow and hopefully some higher return. Although again, in a low yield environment, you're not getting a great return from that environment right now.
And just to make sure everyone understands the idea of the bond ladder, it's not one individual bond, it's a series of bonds with different maturities. So effectively, you're almost replicating a paycheck to some degree. Is that an accurate statement?
Yes, that is correct. So another asset that could be within that bucket would be other liquid or lower volatility assets. Those would be the types of things that would have maybe a higher expected return than core fixed income or that bond ladder, but have that minimal volatility. So if you did need to sell those assets for an unforeseen situation, you'd have the ability to do so. And then as we look to the long term, we can separate out truly growth biased assets that are there, whether it be equities, private assets, real estate, that are there to grow for the long term. So that way, if you have those separated out into separate buckets or accounts, it doesn't necessarily matter if you have fluctuation in your medium or long-term buckets. As long as you have enough capital in that short-term bucket to cover expenditures, you can rest easy knowing that the others will eventually recover.
Yeah, I wouldn't even look at the growth bucket because I know that's going to be more volatile and that might keep me up at night versus the first and potentially the second bucket. I think it's a very interesting strategy. I appreciate you sharing that with us. And then when you think about, maybe just the overall asset allocation, I mean, somebody's entire financial situation, all of their assets, we talked about a couple of different things as it relates to overall risk tolerance. We could also factor in what's known as risk capacity. And as we think about the sequence of returns, so how does the overall asset allocation play a role in this?
Mm-hmm. I really, for any of our clients, having proper asset allocation is very important. So it definitely plays a role when we get into a sequence of returns, especially in an environment where we've been in the last 10 years, where we've been in an equity market that's done nothing but appreciate with a little bit of volatility here and there. We can tend to have an over allocation that occurs, whether there hasn't been proper rebalancing or there's just been a flight to assets that have overperformed. It can create imbalances in the overall portfolio and maybe create a situation where there's too much risk being taken in the portfolio than there should be. So it kind of comes back to our stress testing of that specific portfolio to make sure that one's risk tolerance truly matches how the portfolio is currently constructed. For that, we can take a look at the portfolio construction as it is and stress test to prior stressful periods. So whether that's looking at what would this portfolio have done if we were to see another 2008, 2009 environment.
Yeah.
Or what would it do if we're in a stagnated inflation environment, yield environment? And that can be a good indicator to be able to show, can I stomach what ultimately would happen in that type of environment? So again, it's healthy for all clients to do as a reminder, but especially for those that are nearing or in retirement that can't really take that more significant downside hit in the market.
Yeah, that's very helpful. Maybe just to recap here, as ways to mitigate this risk, and we think of the spending itself. And again, it doesn't matter whether your portfolio is $500,000, $1 million, or $10 million. If someone's spending way too much and it's going to impact them over the long term, and they can see what that impact is, especially with this sequence of returns risk, that's obviously important. Mm-hmm. the 4% rule. We know it's kind of the golden rule that's out there, but everything's a little bit different. People are different. Times will be different. And then even inside of that, you have different inflationary factors. For example, the healthcare spend that you have may increase a lot greater or a much faster rate than a different expenditure and so forth. So there's other things to take into account. Really appreciate the bucket approach and kind of what that looks like and breaking it out and truly simplifying it for folks. And then your overall asset allocation, which is key to your point, and making sure we're factoring in all of the different variety of risks. So thanks for helping us with that topic. Before I let you go, we ask all of our guests the same question. And the question is, what's your worst financial mistake you've ever made?
I think it's market timing. It's one of those things we talk about our clients to not try to time the market. Yep. We ultimately, sometimes as advisors, don't follow our same preaching. So,
or we learned back in the day, and now we're better off for it, so we preach it today.
Exactly. So I think that's myself. I've learned, and it's one when we talk about this topic, for sequence of returns, some of the more challenging situations I've seen clients go through is making that market timing call at the wrong time. And in most cases, it's getting too conservative at the wrong time when you've already experienced that decline.
Yep.
And it continues to create a more challenging environment going forward.
Well, I appreciate you sharing it. Appreciate you being here. So everyone, thanks for listening to the show today. If you have questions, ideas, comments for the show, please go ahead and email them in at podcast@marinerwealthadvisors.com. Thanks again for listening.
Mariner LLC, doing business as Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor. Registration of an investment advisor does not apply a certain level of skill or training. MWA and its representatives are in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which a notice has been filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in a state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. Visit www.marinerwealthadvisors.com for additional disclosures. Mariner LLC, doing business as Mariner Wealth Advisors, will be giving one pair of Apple AirPods per episode to Your Life Simplified following the initial run date of this commercial, provided that there are submissions to choose from. Winners will be selected randomly. Each winner will be emailed to notify of the award and will be asked to provide a mailing address to mail the prize. The email address submitted will be subscribed to Mariner Wealth Advisors communications, including, but not limited to, our newsletters and email campaigns.